can't have high rates, high growth, a slowing economy.
High dollar.
In other words, the equity market can't have everything it wants, right? It can't have the equity risk premium normalized by rates coming down to it and have 10% earnings growth next year. It can't have both. It only can have one or the other.
Yeah.
If it's that we're going to get the 10% earnings growth, but we're going to get higher rates, then the equity market needs to come down to where bonds are, right? You can't have both.
You can't have
so
both.
One has to give. One has to give. Either earnings estimates need to drop considerably, or the equity market needs to drop considerably.
Welcome to the Rose Show podcast. Thank you for joining us today. I'm here with Michael Kramer, CEO and founder of Mott Capital Management and Thematic Growth Portfolio. How are you doing today, Michael?
I'm doing great. How are you?
Great. So excited to be here with you after our nice summer that we had. And we just had a discussion of how great our summer has been here in Long Island, enjoying the beach. How's everything going on? How's September treating you?
So far it's going the way that I like it. The high quality growth stocks are hanging in there, and that's what I've been focused on and on owning. And I used the summer months to raise some extra cash because I wasn't really feeling the rally we were seeing. So things are working the way I want. Dollar up, rates up, economy's still hanging in there, doing pretty well. Inflation appears to still be pretty sticky. All the things that we've been talking about, I think between the two of us, probably for the last 9 months to a year.
Exactly. And energy is up as well, as we discussed last time we met. You're like,
Right.
Watch out when that energy goes up and the oil goes up, that's going to pull a lot more up with it. And that has been occurring. So we could see an uptick in inflation with that as well.
Well, yeah, it looks like, right now, the swaps are pricing in a 6/10 increase for month over month August CPI. 3.6% on the headline year over year. And then you look at the ISM services number today, which came in second month in a row, was up. Not totally surprising given that we know CPI is going to be up again this month. But, it'd be interesting to see what happens in September, because you got a third month up on that. That's going to maybe change the narrative around when that number prints in early October. It certainly seems like the economy is doing a lot better than what everyone thought it was going to do. And I think that's why we're seeing rates where they are and the dollar doing what it's doing. And I think that's going to ultimately be a big headwind for stocks. Yeah.
Well, GDP also coming in, Atlanta Fed, I think 5.6% growth for Q3 estimated. Right. And then we had the ISM number today, as you mentioned, the services PMI. It's been 8 consecutive months of growth. I think it was only last December.
Highest number since February.
Yes.
And the ISM employment reading was the highest since December of 21.
Yeah.
So much for a mushy labor market. And what's interesting is that everyone's focused on this JOLTS data and the softening. And I don't know if you've noticed, but the last couple of months, the number of people not in the labor force has been shrinking. And so what that's sort of suggesting to me, and if you read through some of the comments, I seem to think that what you're actually seeing in the labor market is that people who haven't worked for the last 2 years because of the pandemic are now starting to re-enter the labor force. And so that, I think, is going to give this illusion that the labor market is softening, because you're going to see maybe the unemployment rate tick a little bit higher, not because people are losing their jobs, but because there are just more people in the labor pool. And it's going to probably push labor participation rate up. It may even cause wages to come down a little bit. But it's certainly, I don't think, because things are softening. It's probably going to be because the economy is doing quite well, which is shocking given the 550 basis points of rate hikes we've had.
Exactly. And tightening liquidity, as we will discuss. I think labor participation rate will continue to increase. as time goes by. And we have to remember a lot of this data that we receive is based on lagging data. It's all lagging and it's the past. So we want to talk about what we're seeing. I think we're going to go into general themes in macro and the markets as we already started. And then we'll trickle down to like the smaller, the sectors and the stocks. And we'll talk about some individual stocks as well. So let's talk with the general theme of higher for longer. Seems that that is the case. Not necessarily, my opinion is not necessarily we're going to go much higher, but I think we're going to remain around this level for a much longer time. And now we're seeing long-term rates rising, the 30-year, the 20-year, the 10-year. So as the yield curve has been inverted, it's becoming less inverted and not the best case scenario, because now the long-term rates are starting to rise. So what are your thoughts with all that? You do so many wonderful charts, Michael. I have to say, you are like one of the best follows on Twitter. I love your charts, your chart comparisons, which, okay, this is September 6th today. Of 2023, but your charts are timeless because you're comparing this whole overall time period, not just today and not just this week, but we're looking at patterns and trends over the course of the past year now and going into the next 6 to 12 months. So what are your thoughts when you're looking at all these rates that are increasing?
So I think the front of the curve, like the 2-year, is probably pretty much done, right? I think if the Fed goes again, I think maybe the 2-year can move up to around 5.25. I think that's really done. That part of the narrative, I think, is over. The part of the narrative that I think is potentially the most dangerous for the equity market is the back of the curve. And so like you, I've been focused on the long end of the curve probably now since about May. And I think the back of the curve has significant room to go higher. I think there's the potential we could see a 10-year approach and maybe surpass 5%.
Wow, 5.
When you just look at it from a technical standpoint. The other thing that I've been looking at quite a bit, and if it's okay, I'll share my screen with you.
Please do. Yes, I think we're enabled. Yes. I'd love to see, we want to see more of your charts.
So we talked about this, but we'll come back to this in a minute. But we just look at the 30-year, I'm sorry, we do the PCE core. What I find really amazing here is that you have a 30-year, which is just barely right now above the 30-year, the core PCE rate. You can see that has never happened before. The 30-year was trading below the core PCE rate.
Wow.
And, you know, I don't know where core PCE is going to be 6 months or a year from now, but assuming that it's somewhere still around 3-ish%, let's say, a 1.2% premium suggests a 30-year at 4.2, right? So right now, at best case, the 30-year is fairly valued, right? But you can see going back in time, those premiums were much larger. And so, you know, just from a fundamental standpoint, you could argue that the 30-year should at least be at 4.2% if we're going to start getting a core PCE reading to come down to the threes, right? I don't know how long it's going to take for that to happen. And the thing that I've been noticing here is that the longer it takes for inflation to come down, the less patient the back of the curve seems to have. And it's almost like the market in the beginning didn't believe that inflation was going to stay as high for as long as it has. Because if we look back here, you can see that the 30-year was really reluctant to move higher. And it wasn't until, you know, call it October of last year that we really got to a point where the 30-year was elevated, but it still wasn't really high enough given where inflation rates were. And then obviously the market thought we were going to go into a recession, although the back of the curve really never bought it. And you can see now that we're starting to finally move above. So the question is where do we go? How far above core inflation do we end up going? And like I said, there's a fundamental case to be made that, if we're in a period where inflation is going to stay elevated for longer and stickier for longer, and it's going to be in this 3 to 4% range for the next year, 2 years, 3 years, then you could make an argument that the 30-year should be at least where it is, if not much higher. And so this is sort of the base case in terms of why I think you could see rates on the back of the curve continue to move up. And clearly, when you factor in things like oil rising and gasoline rising and diesel prices rising, and then you get the ISM services data point today, which suggests that maybe the prices paid index services aren't coming down as quickly, that certainly can also begin to add to the idea that 30-year rates should be higher than where they are.
Very plausible argument there. And I look at these patterns. That's what I love about these charts. And you see that pattern there. And then you have to say, is this time really different? And I think that, we live in market cycles, we live in economic cycles, and history isn't necessarily the same and doesn't repeat, but it does rhyme. And those patterns mean something. And this chart that you have, you're showing the 1980s there. You're going as far back as what, 1975? Oh, that's the year. That's a very special year, right? That's around the time period of when we were born, yes. I guess. But yes. That time, that 75 to 79. So yeah, I mean, this is pretty clear to me that this looks like it's going to go green, like you said.
But I mean, look at the premium the 30-year was at when in the 1980s, when core was actually lower than where it is right now.
Look at that. It's a 40-year. Well, this marks the end of the bond bull market. We're in a bond bear market. It's a 40-year bull market we've had. And look at that downward. Look at that, how it's getting closer and closer. And then they switch.
Right. And now it's switching back the other way.
Yes.
But I mean, at one point you had, core PCE at 10%, you had a 30-year at 15. Then all of a sudden, you start getting core PCE coming down to 4.25%, which is basically where we are now. But the 30-year at that point was 12%.
Yeah.
Right. Not 4.25%. So it almost seems like the market has very much given the benefit of the doubt that inflation was going to come back down. And so my belief is that the longer inflation stays elevated, the longer it takes for inflation to come down, the more likely it is that you're going to see this rate continue to sort of creep higher, because the market's going to start really saying, hey, you know what? Maybe we're not going back to this 2% inflation rate. Maybe it's going to be something where it's a 3 to 4% number. And if that's the case, maybe that means we need a 30-year closer to 5 to 5.5%, something more in line with what we were seeing, in the 80s and 90s and mid 2000s even. It wasn't that long ago that we were, easily over 5%.
Yeah, well said. I think we're going to have some sticky pockets. And I think that the core is very sticky at about 4.7, 4.8% year over year. And I believe, according to Cleveland Fed, and I know last time we met, we said, Cleveland Fed maybe more on the high end versus the low end, right?
Well, I mean, we're talking about by a tenth or two, right?
By a tenth. Okay, so we're in the ballpark. So it says August, we're looking at about 4.46% core. I mean, that's high. And then 3.8%, but we're still rising at 0.38% month over month. And then September, still 0.37% month over month with a core over 4. Now, over 4 is still very high and concerning, and will affect that line that you're showing us right there.
Right. And the market right now, we're assuming, is pricing off of those expectations. So if you were to get a core number that's hotter than the numbers that you just quoted, you're talking about even higher. Right.
Absolutely.
And so again, like the thing here is that where is you can't have nominal growth the way we've had it over the last 2 or 3 years and not expect to have significant amount of inflation, and then think that the economy is just going to go back to what it was before the pandemic began, right? I mean, nominal growth has been tremendous when you look at it just on a year-over-year basis. So this is not seasonal. The number I'm going to show you is not the seasonally adjusted annualized rate. This is just a year-over-year number in nominal GDP growth. And when we look at these numbers, we're looking at 6.1% year-over-year GDP growth in nominal terms, which are still higher than almost everything we've seen in the last decade. And so, again, like, it seems to me like as long as nominal growth stays this elevated, we're going to continue to see some sort of inflation, because let's say, you have like nominal growth of 6%, you have a inflation rate at 2%, that would suggest 4% real GDP. And that would also mean that you probably have a 4% productivity rate, which is not going to probably be likely, right? And so what the most likely scenario is that I think that gets inflation finally down is you've got to get this nominal growth. I think we've talked about this before as well. We have to really get this nominal growth rate lower. And you got to get the nominal growth rate somewhere to probably about 4% to be able to get a 2% inflation rate and a 2% productivity rate, which is still high, which means that maybe you need to get it to 3%, right? And, now you're back to more of what we've had over the last decade. We're still double that. So this isn't going to happen, overnight. This is going to continue to probably drag on for several more quarters, right? I mean, if you just take this line and we just do a regression on it, and just to get a sense of the trend, right, from here, I mean, this takes you out into the, if we want to get to 3%, that's the first
painful.
quarter of 24. That's the first quarter of 24. So you're still talking like another 9 months or so. And if you want to really, and that's just assuming this trend persists. Now, knowing that the third quarter appears to have accelerated a little bit, what if this trend changes? What if instead of it being at 6% for the third quarter, it's back to 7.2? Because when you look at the GDP Atlanta Fed number, they give you another number in here, which is the PCE number. And when we look at what the PCE estimate is for here, I'll show you. Where is it? PCE for third quarter is currently estimated at 4%. So according to this model, we're actually, if this number comes in at 5%, which is probably unlikely, you're talking about a 9% nominal growth rate again. And so let's say Atlanta Fed comes in at 3%, and PCE, instead of being 4%, comes in at 2 or 3%, you're still talking about a 5% nominal growth rate. So again, like it's going to take more time.
It will take time. Agreed. And that's what we've been saying. This is a slow grinding process, and it'll definitely take a long time to work through the system. And we do see, liquidity is decreasing. Higher rates cause higher rate premia and lower liquidity and higher volatility. And I think that OPEX is this month it's the largest OPEX of the year, September, and then comes March. I think we're going to see some more volatility. And it's very disconcerting. I think what we're here to do today is to discuss potentiality. And there's a lot. And we need to be aware of what can happen. We're not here to predict. We don't know what the PCE is going to be in 6 months, like you said, but it's just to know that this is the pattern of what's been going on. And some of these numbers, like you said, a nominal GDP of 9%. I mean, that's crazy. I mean, that's a lot. And
Yeah,
it is
and
painful to come
and
down.
I don't think we should expect for it to be that high.
No,
Because this chances are this real number is too high, right?
it
This
is
real
too high. I think it's going to be revised lower. It's going to come down lower.
it's
That's
probably
my
going to
opinion.
continue to come down lower, and maybe it comes in at around 3%. But 3% real GDP growth is still a very fast.
Yeah, and if you have
growth
PCE
rate.
at 4%, you're looking at 7%.
Correct.
That's very high.
So even if you get a 3% real rate and you get a 3% PCE, you're still talking about 6% nominal growth, which was what we had in the second quarter. Again, this is on a seasonally adjusted annualized rate. The numbers we were looking at before were year over year, so it's not exactly apples to apples in terms of how we're thinking about it. But again, it's just more of the sense of the overall trend. And it seems to me that the overall trend suggests that probably nominal growth is going to have accelerated when it comes to the third quarter on that third quarter year over year comparison.
Yes, well said.
If that makes sense.
No, it does. It does make sense. It's something to watch. It's important. Fundamentals matter. And I like to quote Benjamin Graham. In the short run, the market is a voting machine, but in the long run, it is a waiting machine. So, it's important to understand this macroeconomic environment that we're in. And it's something that can take a long time. Like you said, it's a slow process, but we need to be aware of this. And the entrenched inflation is very concerning. I mean, we have high prices all around us, right? And, inflation is cumulative. And so we have high prices and, it's tough times. And plus the debt. I want to talk about the debt. Debt to GDP is over 118% as of Q1 2023. And consumer debt is increasing as well with higher costs of debt and capital. It's a higher cost of money. So that's another issue, another headwind going forward. And like we talked earlier about the housing market, it's the most unaffordable market in I think over 40 years. So a lot of factors there. What are your thoughts on all that, Michael?
Well, I mean, the debt isn't going to help treasury yields, right? On top of the fact that, you don't have the Fed buying bonds anymore. So that liquidity has to come from someplace. The reverse repo facility has certainly been coming down some, and that's absorbing some of the liquidity. But that's certainly an issue. And if the government spending and the deficits continue to run as high as they're running, then you have to think that rates are also going to reprice for supply and demand dynamics, right? And it seems like that that's really becomes an unsustainable path at some point. And really, the higher your deficits are, and if rates are a reflection of where inflation is, it's telling you you're probably going to have inflation rates that are elevated for a longer period of time. Again, like it's sort of amazing to me that people think that you can have government spending the way we're having it but have no inflation. It really, it all just goes hand in hand. I mean, the reason we have inflation now, I think there's a major underlying characteristic of what's the difference between what happened post 2008 and what happened now, right? In 2008, we had QE. The Fed did about $4 trillion in QE, and they cut rates to zero, but we got no inflation. But we also had a very small stimulus. It was what, $800 billion or something at the time. I don't remember the exact number, but I think it was only like 4 or 5% of GDP. Now you come to today, the Fed's done another $4 trillion in QE, but it did like what, like 4 trillion or $5 trillion in stimulus measures in terms of fiscal spending. The difference between the two is that fiscal spending post 2008 was a fraction of what the fiscal stimulus is now. And so when you have a dynamic of low interest rates with high fiscal stimulus, you're going to get inflation. So the theory basically is that QE isn't really what caused the inflation. It created an environment to keep rates low enough to create a risk appetite, but that the physical spending side of the equation compounded QE and gave us this massive inflation rates that we have right now. And it's the reason why that inflation probably doesn't go away anytime soon unless you get a recession, because that money is still in the system. It hasn't left.
Exactly.
Right? And you have the money multiplier effect. So, this is not going to be a problem. I remember Obama at one point said it took us a long time to get us into the mess. It's going to take a while to come out of it, right? Same thing here. It took us, we got into it really quickly because we just injected so much liquidity into everything because we didn't know what was going to happen. But the size and the scope of it was like something we had never seen before. And we have to assume that now this is going to take a really long time to unwind.
Agree. I actually did a tweet about this. I think it was 3 weeks ago. And I did some research on the PCE and how it followed the M2 money supply down. And it was like an 18-month lag on that. And it was basically, I always say I go back to Milton Friedman, and, inflation is always and everywhere a monetary phenomenon. And, it's when too much money is chasing too few goods, or just too much money in the economy, but it's about that M2. And we've discussed this before. When the money supply, M2 growth, exceeds the output, real output, very important point there. You have inflation. And back to your point about 2008, money base was increased, but it did not increase M2 due to the swapping bonds for reserves. So it actually increased their reserve ratio. So it didn't actually reach the economy, which is why it didn't cause inflation, which is based on that research regarding PCE and the M2 money supply. It was a really interesting phenomenon about that. And then we can go into the quantity of money theory and all that. And the velocity of money is another interesting point. But yes, back to your point, it's about that M2 money supply. And we're now in 2020, mass stimulus, and it's a new environment that we're in with all the stimulus we've had, free money, negative rates. So it will take a lot of time to work through. What are you seeing with the tightening liquidity? Are you seeing that starting to tighten, dry up, or still a lot of it floating in the system? You have some great analysis on that, Michael.
It seems like, here I have a chart on M2 here.
Great.
You can see this is 2020.
Yeah, look at that. Wow.
So,
and the government spending to no end. Absolutely.
So, liquidity, I'm trying to pull it up. So reserve balances really haven't been changing for a while. They've been pretty consistent at around 3.2 trillion. And we just haven't really seen it. It's sort of, I don't know if you can do technical analysis on reserve balances, but it looks like we're
if it can be done, you'll do it, Michael.
What?
If it can be done, you will certainly do it.
Yeah, I mean, it almost looks like we have like this wedge forming here,
Yeah.
And I'm curious to see like where we're going to break. Is it going to break? Because the Fed keeps doing QT, but at the same time, the Treasury keeps issuing more debt, That's causing the reverse repo facility to decline, but the TGA is a liability on the Fed balance sheet. So it's kind of really an interesting like mixture of things going in right now. And you're not really seeing reserve balances shift very much in terms of, where they are in the context of the system. In fact, reserve balances have basically been pretty stagnant now since June of last year. When we look at things like global liquidity, that's been showing more signs of decaying. And some of that's a function of the dollar strengthening, because remember, in this model that I have, what I'm doing, and it takes a really long time to load because it has a lot of data points it's pulling in. What I'm showing is the balance sheet of the Fed, the ECB, the BOJ, and the PBOC, all in dollar terms. So when the dollar strengthens against these currencies, it makes the size of their balance sheets smaller. And it means that the liquidity in the market is, declining. And you can see there's a very large divergence between the two. Again, I mean, there have been divergences like these in the past, and it's not to say that this can't persist, but that's not what historically has tended to happen. And so
doesn't the SPX seem to follow the balance sheets? Is this the G5 and plus China, or is this more?
No, this isn't the G5. In this case, it's just the US, Europe, Japan, and China.
Okay, so 4. Okay, so does it follow? Do you think there's a follow pattern here?
Well, I mean, it certainly looks like, if you look at the white line, it certainly seems to be leading the way.
So that means blue's going to be
down. And you can see that on the rise here, liquidity was well in front of, and it peaked well before the S&P 500 did. I haven't really taken the time to think about this before, but you're pointing it out.
Well, I noticed you tweeted this, something similar to this, and I was analyzing the chart. And what I noticed, that just for everybody, if you can't see it, SPX is the blue line, and the white line is these 4 countries. I saw a G5 from you, but this is great. G4, this is just 4 countries. And right there, it looks like the blue is going to follow the white.
Yeah, and so if you look here, actually, you can see that the liquidity peaked around September of 21.
Makes sense.
And the S&P didn't peak until January. So what is that, like 3 months? So in this case, liquidity turned down in April, and now we're in September. So what is that, 5 months? I don't know. It's not really outside of the realm of possibility that we just haven't seen. There's a drag.
There's a drag for sure.
A drag in 5 or 6 months.
Could be 6 to 9 months. It could still be in the window.
It could be, and you're still in the window. I don't know, right? And that's really it's always easy to see it looking backward. It's not so easy to always be in the middle of it and try to predict it. But certainly, if the thought process would be is if the liquidity lifted the market, then when the liquidity is falling, it should really be draining the market.
Well, I'm just going to ask you a quick question before we move into the next part. Right there, you look at the 2000, where is it? Back to where the big disparity occurred. I'm trying to see if we can look closely right there. The big jump, and then it goes down. So it seems that the wider they diverge, and then they converge quickly. I think it was 2008.
2018, you mean?
Or 2018, yes, right there. Yes.
Yeah, then you get the big sell-off.
Yes, that's what I'm saying. And then you get also 2019 or 20 right there. That was COVID.
Yeah. So what's interesting here is that, we had this, we had the balance sheets around the world coming down. We were certainly in QT here in the US. And I'm just trying to load the other chart on the side while we talk. Of the G5 one that you mentioned. The balance sheet was coming down during this point, and you remember this was when the market sort of twisted the Fed's hand into starting to pause. And when you zoom in a little bit closer here, I think that's too close, but here you can see, again, the balance sheet was shrinking. And then right here was around the time that we got the China trade deal, and we also got the Fed to do not QE. And if you notice, the balance sheet started to rise again. It's very subtle. It's very, very subtle. You can't really see it very well, but it did begin to rise again. And that was when we got a really big move in the NASDAQ, in the markets. You could see here it peaked and sold off and then came down. And then we got a big ramp up, because this is when they started with, QE again. Following the start of the pandemic. So, I mean, it's certainly possible that, there are some lags, and that I've actually gone through the process of trying to analyze the relationship between the market cap of the S&P 500 and the size of the Fed balance sheet. I call it the reserves to market cap ratio. And I have a chart on that as well, much to your surprise, I'm sure.
You tinker. I love that you tinker and you find all these great correlations.
They're just very difficult to load, because they're very. I'm trying to load it right now.
Well, we're patiently waiting because this is exciting. Ooh.
So this is a chart of the market cap of the S&P 500 in white. And then in blue, you have the size of the Fed balance sheet. And on the bottom, you have a ratio of that. And what I found interesting is that, for the most part, if we zoom in more closely on this period of time,
it's rising.
It was kind of steady, though. I mean, you see how it's kind of around 10 times for quite a while. And then it's like, it got a little higher, and then it came back down again, because you got this big influx of cash here right around SVB, right? And then it's like, it's kind of moved up, really up to the very upper end of the range at this point. And so I guess, the thing is like, is there going to be some sort of return here to the norm, revert to the mean, a reversion to the mean? Right back to where it was? Because certainly, if you go back into this period of time, you can see that the ratio was falling, and you can see the average, and we rose back to the average, and then we kind of stopped. We got really way too far out in front, and then we came right back down to where we were previously. So I don't know. I mean, if we were to see the market cap of the S&P 500 go from, back to, call it 10 times 3.19 would be 31 trillion, 39 trillion, that would be $8 trillion in market cap erased. You can do the math, but what's 8 trillion divided by 40 trillion? 20-ish percent. This is the G5 chart. I don't know if you wanted to look at this one quickly too.
That'd be great.
It doesn't really look all that much different, right?
That's why the other one looks so much like this one.
Except there's more of a decline here than there is on the other one.
Wow.
So, I think that there's something to these divergences.
I agree.
Because there is some sort of formularity to it. I think it's not coincidence. I don't think you could have this type of thing and just be a coincidence for this long of a period of time in what's supposed to be a really random market, right? Remember, I forgot what to say. What is it? The random walk?
Oh yeah, something like that. Yeah.
So I mean, I don't know. I mean, and what's interesting is that it's not just in the S&P that this exists. It also exists in the NASDAQ. I mean, look at that.
Wow.
So I don't.
And this could persist for much longer. I mean, I think it could. I mean, you look at that high over there.
Well, it could and it may not, because if you want to see another chart,
yeah.
let me see if I can find it really
I mean,
quickly.
my gut feeling when I look at these charts is like, I think it's going to have to revert back to the mean.
Well, let me just see if I can find this open recent
Something's got
here.
to give, like that movie, right? Something's got to give.
There's another chart I have in Excel because I can't recreate it in Bloomberg if it opens.
Mm-hmm.
This is um so this one I just updated this through June. This is the S&P 500 in orange, and in blue is debit balances. FINRA debit, margin.
Yeah, they're starting to
Okay,
rise.
so you can see there's a relationship between the two, right? We've established that.
Absolutely.
So now, you just gotta take a look at this. This one shows you the relationship between, oops. This one shows you the relationship between reserve balances and debit balances, margin. So you can see that when QT really persisted in 2000, margin balances kind of fell, right? Which then led to, the S&P 500 sort of going through a period of a lot of volatility. And so what we're also seeing here is that reserve balances fell, margin balances fell, the S&P 500 fell. And so you can see here that we've stalled out. Margin balances increased. Margin balances increased. The stock market increased, right? So the theory here being that somehow changes in reserve balances are affecting how much margin and leverage is available to the system. And depending upon how much leverage there's available to the system is dictating where stock prices go.
Of course.
And so where, how long can this persist? It can persist as long as the banks feel comfortable with where reserve balances are, that they're extending credit basically to people to put in the market. That's the general theory that I have here. And again, like I don't know, but this goes back to the idea of financial conditions, because if financial conditions start to tighten again, that probably means that institutions are pulling back on liquidity, which probably means that you're going to see leverage begin to decline in the market. And so my guess here is that with the dollar strengthening, with rates rising, with the start of, credit spreads beginning to widen some, you're going to see institutions pull back on leverage. And it's more likely than not, I think, that we're going to see this NASDAQ one, let's say, go from 5.7 back to 4.7, right? Which would be, and the S&P 500 go from 12 back to 10. And so that's why, like, I focus on some of the things I focus on, because of how I think everything is related to one another. So
there are a lot of moving parts that keep moving, and there is some reasoning and correlation to all of this. And I think that makes a lot of sense. And when I saw you tweet the G5 with the S&P, I saw that relationship, and it seems that probably in the next few months. And what's interesting is that economist that we talked about, Steve Hanke, he says that the recession is baked in for Q1 2024 due to the shrinking of the money supply. It's the fastest rate since the 1930s. And I was going to ask you, what are your thoughts about recession, stagflation, all of that? We always talk about it every time we meet. So let's update with what you're thinking when you look at all of this and what's going on into 2024.
So I'm not sure. I mean, obviously he has a fantastic resume, right? And it's kind of hard to go against what he's saying because of his reputation,
We'll put you
obviously.
second. We'll put you. You're the second. Right? You're next to
But
him. We'll put you.
I don't think we're likely to see one in the first quarter. I think that based on where we are, if third quarter growth accelerated as it appears it may have, then my thinking is that nominal growth probably has accelerated as well, as we kind of talked about. And that makes me think, that the timeline is probably getting pushed out.
Yeah.
And there's a, I'll try to pull this up here. There's another indicator that I watch, which is, I call it the Powell indicator, because he made reference to this on a few occasions. This is the 3-month Treasury bill, 18 months forward.
I love this one that you do. This is a great one.
Spot market. And we're still all the way down here. And we're really not, it's really not re-steepening. And typically, by the time it really starts to re-steepen, you're really already in recession. At least the last 3 times that's happened, right? We don't have data beyond the year 2001. So this would tell me that no, we're still have some time, because at least based on these numbers, I mean, this was negative 22, maybe if we try to just zoom in a little bit and see like where it was when it crossed somewhere around negative 22. If we look here, it looks like we were maybe around negative 0.1. It seems like the curve is still too steep. And I try to think about these curves not so much as, I try to think about them as a timing mechanism. And when they begin to re-steepen, that's a sign that the recession is coming. Maybe the recession is, again, still another couple of months away, but that it's coming. And it's not even that it's re-steepening. It's the method in which it's re-steepening. Because right now, what we're seeing is the 10-year rising. We're seeing the curve re-steepen, right? But we're seeing it re-steepen in a way that's not indicative of recession. We're seeing it re-steepen in a way that's indicative of an economy that's re-accelerating. Because what we're mostly seeing is the 10-year rising to the 2. And you're not seeing the 2-year falling to the 10. The recession signal specifically is the 2-year falling to the 10, because the market is anticipating Fed rate cuts, because the market is anticipating recession. In this case, the 2-year hasn't done anything, and it's 10-year rising to the 2, which is indicative of stronger economic growth or potentially higher inflation.
Exactly.
And the reason why I think it may be the call for higher inflation is because what we're seeing in break-evens. So if you look at a 10-year break-even rate, inflation expectation, it hasn't changed. So what that's telling you is that real yields are also rising with the 10-year. So you have a 10-year nominal rate at 4.3. You have a 10-year real rate at 2%. It gives you your 10-year break-even inflation expectation of 2.3%. And what that's telling us is that, or at least what I think that's telling us, is that monetary policy isn't restrictive enough to bring inflation down. Because if monetary policy was restrictive enough, we would be seeing these break-even inflation expectations falling off a cliff. And that's just not happening. I mean, we've been here now for some time, versus where we were for the last decade, right? So there's been really no change. And so the 10-year rising, I think is an indication of the market saying that maybe rates need to be higher because the Fed hasn't done enough.
Wow. I think your argument makes a lot of sense. I like it. I think it's great. I think everything's getting pushed out. And I think that you use great term, and I love the way you use the words. You said it properly. A lot of people mix up the steepening versus flattening and all that, and you use great terminology. But your argument makes a lot of sense, and it could be pushed out. And maybe we see something sometime mid next year. You think that seems probably more likely then?
Yeah, I mean, it really depends how much further rates ultimately have to go.
Yeah,
Because
I mean,
one thing seems clear to me is that if the Fed isn't going to do it, the market is.
yeah,
And Powell's best friend right now would be for rates on the back of the curve to continue to rise. Because we can see that there's no slowdown in growth expectations. I mean, this is not only a measure of inflation, but it's also a measure of expected growth.
yeah,
Right. And if the market were perceiving a major slowdown in growth like it did in 2014, 2015, when the market was, remember in 2015, the Fed was thinking about raising rates. They were thinking about raising rates. And then they were finally going to pull the trigger in December. Well, they ultimately pulled the trigger in December of 2015. And the market was like freaking out in that beginning of 2016 because the market was saying, no, it's you can't go yet. It's too soon. And we saw these break-even inflation expectations just declining like crazy. You're not seeing that here. And so what this means is that probably means that nominal rates have to continue to rise on the back of the curve. Real rates are probably going to continue to rise. And that's going to do the tightening for the Fed until we start seeing these inflation expectations falling.
Exactly. Well said. That's what they want. And as we heard Jay Powell speak at Jackson Hole, he was very hawkish. He said he's going to keep at it until it's done. And these are highly intelligent, competent people. And they know what they're doing. And it's exactly working in his favor, like you said.
Look at the 2-year.
I
mean, it's actually starting. Well, I mean, oil keeps going up. It's going to actually start rising again. Because, all these things they just mimic. Everything just like mimics each other.
Yeah.
Right. And then you begin to realize this is just one giant circle.
Yeah.
Right?
They're all moving parts and they keep moving.
Giant,
Yeah.
So, I mean, this is telling you, right, the move higher in oil is telling you that there's going to be a move higher in inflation expectations. And so it's impossible, I think, for anyone to know at this exact moment in time where the terminal rate is and when the Fed is actually going to be done. The problem is we're not going to know the Fed is done until it's too late.
Yeah, you always know in hindsight. So,
right.
Wow. So we could actually, I was thinking maybe we got another quarter out of this 25 basis points, but looking at this, if this continues, we could be in for possibly more. And then I think it's the longer part. I think we're going to stay at this restrictive monetary policy for a while, unless something serious breaks. I mean, we had that banking crisis and we all thought, everyone thought, this is it. The Fed's going to go and ease. And, they did a little bit of fixing whatever they needed to do. And then they're back at it. So.
Yeah. And because everyone has, the bias of 2008 still in their mind. But
yes,
look at the Treasury curve for real yields. The whole curve is over 2%. The only one not over 2% is the 10-year rate, and that's at 1.9925%. The entire real yield curve is over 2%.
Wow.
And so there isn't even like what's odd is that the 10-year seems so out of place given where the 7 and the 5 is and where the 20 and the 30 are. I mean, the 10-year is like sort of the low man on the totem pole at this point. It should probably be higher based on the shape of the curve. But I mean, the whole curve is telling you that rates are going to be more restrictive for a very, very long time. It's not even telling you the rates are going to be restrictive for 10, it's not even that they're going to be restrictive for 5 years, 10 years. It's going to be 30 years that they're pricing in restrictive monetary policy at this point. Look, the market's probably overdoing it. It's probably, wrong to some degree, but what this is telling you is that real yields are going to go back to where they were in the 90s, which are going to be, steeply positive.
Exactly. Yep.
Which tells you that we're not in the post 2008 GFC world anymore.
No, I don't.
The market's clearly telling you that.
I think we're in a new time period where I think that we have market cycles, but I think we're back to a different period. And I've spoken to many great people who said that this is like the 40s, and they go back to that period. And then others say it's the end of a 40-year period, and we're in for a secularly inflationary time period coming up. And so there's so many different ideas out there. But what we know, you and I could at least assume this, that the coast is not clear, and that we're not going to have this very soft landing, as well as cutting rates and this fantasy world, right? I mean, I call it like a fantasy land, right?
It is. The fantasy of inflation melting away, I think, is going to be proven to be incorrect. And I think the biggest risk that the equity market has mispriced is interest rate risk.
Exactly.
And I think that, and I don't necessarily mean Fed funds rate risk. I mean back of the curve type of risk.
Yes. Where it matters for people, when you buy homes, because that's what you're buying is the long term. You're getting a 30-year mortgage, right? And it's a higher cost of money, higher cost of debt and capital. And it's already working through with commercial real estate, for example, or shorter term loans. So they're already refinancing with this higher rate environment. However, and small businesses are very sensitive to rate hikes and rate increases because they're constantly using that for, cash flows and, any type of financing, long-term debt or even short-term. However, it's these broad-based, we're still going to take time. It's going to take probably larger corporations. They have until 2024, 2025. So it's going to take time to keep working through the system. And there's a re-rate of risk. And that's the thing I want to bring up. And I know you know this so well, is that, we lived through the other time periods, even as kids, and we remember. And there's a recency bias. People think we're going to go back to free money, lower rates again. And it was this mindset that, money went towards riskier assets because the cost of money was cheap. Now the cost of money is much higher. So there's just a different rating of risk. And I think people are going to learn, and some may learn the hard way as they accumulate too much debt and they're not curbing their spending. And you don't realize that, these are different times than what we've been in. So, I'd like to look at the markets, the PE ratio, and our favorite ERP, equity risk premium. I know we talk about.
I knew you were going to go there, so I already pulled the chart up.
Already had it available. It's important to look at that, just to gauge where the S&P and NASDAQ are in comparison to these rates.
I mean, you can see the NASDAQ 100 earnings yield.
Is it zero?
Less the 10-year real yield is at 1.63%.
Wow, it's I call it practically zero. I mean, compared to where it's been.
Yeah, well, that would be a pretty painful reversion to the mean if that were to happen. Back to 4.25. You're talking about, well, you would need to add almost, call it 3 percentage points to the NASDAQ 100 earnings yield of 3.6. So if we just do some basic math, right, and we take 1 divided by 0.0362 or 1 divided by 0.03662 gives us a P ratio of like 27.
Oof,
Seems kind of high, but that's what it
very
is.
high.
And then we were to add, let's say, if we were to take 4.28, you're remembering this, right? Minus, I'm sorry.
Yeah.
1.63.
4.28. I got that.
2.65
Uh-huh.
plus 3.62, which pushed the yield to 6.27. 1 divided by 0.627. We pushed the NASDAQ yield back down to 16. So what was that first number I told you? 27?
Yeah, 27. I remember that.
27 minus 16 is 11. 11 off of 27 is 37%.
Oof, 37% drop.
You'd see nearly a 40% decline in the NASDAQ 100.
Wow, it's almost cut in half.
If we were to return to this average of 4.34% over the last decade.
Well,
Now, I don't know if we're going to return there all the way, but we could certainly move back to 3%.
yeah, or at
right?
least over 2% seems warranted. 2.5.
Yeah, I mean, if you were to move back to this area of consolidation, right? If we were to play technical analysis here, we're at support, right? Or maybe we're breaking support to the downside, it looks like at this point. I actually just did this morning, and I updated it. So let me update it again. 1.63. So you can see the line down here. I mean, again, if you just move back up to 3%, you're talking about 1.5% to this 3.6. That pushes it up to over 5%. Stocks are just extremely expensive to what you can get in rates. And I don't, and it's really tough because this is a very subjective thing. Where should the quote unquote equity risk premium? This isn't really the equity risk premium as in so much that it's just a spread. Like we have high yield spreads. This is like just another way to look at the value.
Yeah, it's always a spread. Yeah.
And, was this normal? Or is this normal?
We don't know.
We don't know. That's the problem. If we were to do, something different, and we were to take, let's say, or we were to take, if I were to set up a chart here for the NASDAQ, and we do one together. So here's a chart of the NASDAQ, right? And we just look at the current earnings yield. What I do there is I use 1 year forward. And we look at the current earnings yield, 3.07. I think the other one was a little bit higher. And then we were to, I don't know, subtract the 10-year treasury rate. I don't really like to use the NASDAQ much because the NASDAQ doesn't have as much history to it in terms of numbers. You can see it's a negative 1.2. And we go back to, let's say, 1995. This is sort of where we were in the mid 2000s. Well, let's just throw in the S&P instead.
Yeah, I like the S&P.
And then we were to maybe go back further if we can. I don't know how much further there is. Oh, a little bit further, 1991. You can see the spread is only 25 basis points between the current earnings yield and the 10-year rate. And, if we look at that, that's lower than every time period from, I don't know, call it 2002 on.
Wow.
Which really takes us more into this late 2001 bubble implosion, right? Sort of 2001. And here's 1998. This is probably long-term capital management and some of that Asian crisis currency debacle. This was the 2000 peak.
Dot bomb, yeah.
-3.5. So I don't when you look at this type of stuff, it's like, well, where is really the right price? Where is the right multiple? And it's really hard to say. All I can say is that relative to what we've experienced for the last 10 years, which is more of, this time frame,
Yes.
this is an extremely overvalued market. Now, another way that you could look at it too is with the dividend yield, which is also another interesting
Yes, the dividend yield.
way to think about it, right? And again, you can see we're at the very low end of the range historically.
Yeah.
Here's 1998, here's 1993. We're sort of in this area where during crises in like the 1990s, you would get to on a high. This was remember, I think the recession was what, 91, 92 or something? I don't remember.
Something like that. Yeah.
So I don't know.
It was the war or something. I don't know.
But clearly, this is not, the market is valuing stocks like something is different. And the thing is we don't really know what it's either valuing it in a way that everything's going to return to how it was, right? With the assumption of rates going back down, because, if you have a 10-year at 4.3%, minus, so we probably have a dividend yield of about 1.6%. So, I mean, if the 10-year goes from 4.3% to 2.3%, all of a sudden this doesn't look so bad. But if the 10-year stays at 4.3% and perhaps goes higher, then this really continues to look worse and worse.
Unless the SPX comes down.
Or the SPX comes down. So basically, it would seem to me that the equity market is betting on a return to rates to lower levels, and the bond market is pricing off of where the actual economy is. And so the equity market, I would say, is still in this camp, or still thinks that the Fed is going to be aggressively cutting rates next year, which was the thinking that we got after SVB. But now clearly we know the economy has reaccelerated, and the effects of whatever that SVB were seem to be completely have been blown out of proportion. And that's why you're seeing rates continue to rise. And so that tells me, again, that I think that means that stocks, this equity risk premium in the market, needs to begin to move back to some of these higher levels that it was at previously. And that's the only way that I interpret this.
Yeah. Well, we think in probabilities, and it's like thinking in bets. And we got to just think of what seems potential here. And the algebraic formula here is, it's a spread. And we look at, it's either, like we said, SPX has to come down, or, something has to give here. Yeah, exactly.
Yeah, either stocks need to fall or rates need to fall. Something needs to fall.
Something needs to fall, exactly.
The economic data,
rates are probably not going to be falling.
That's what the economic data tells you, is that rates aren't going to be falling. And the longer inflation stays persistent, not only is it more likely than not that they're going to stay elevated, but it seems more likely than not that they're going to actually rise.
See, this is just another data point, and that's what I love. All your research is data driven. And this is just another point that just demonstrates that, we are in a different regime now. We're in a different time period. Rates are higher than they've been since pre-GFC. And I think we need to start thinking differently. And I think that based on this and everything else we discussed, it seems that there's a lot of potential headwinds coming forward for SPX, the S&P 500, and as well as NASDAQ. And something's got to give.
The only thing that saves the S&P here, right, is whether or not companies can continue to somehow grow earnings?
Well, with the dollar higher, right?
I don't know how they're supposed to do that because, I mean, if you look, I mean, we're expected to go from $219 a share in earnings this year to $245 a share next year. How much growth is that?
That's
Like, is that more
significant.
than 10%?
Mm-hmm.
How is that going to happen if, well, okay, let's use the equity market logic. Fed's going to have to aggressively cut rates, right? So the equities market logic is Fed's going to have to aggressively cut rates, which means the economy is probably going into a recession. Okay, well, if the economy is going into a recession, we're not going to have 10% earnings growth. That's for certain.
Yes.
If you look at it from the bond market's perspective, inflation's likely to stay sticky. Economic growth is going to continue to stay strong. Then I could argue for a 10% earnings increase, right?
Mm-hmm.
So I guess the question is a 10% earnings increase going to be driven off of sales growth, which inflation is coming down, right? So perhaps that means that sales growth is going to be more subdued, or is it all going to come, from here? I'll show another chart. Because if we look at sales growth, that is expected to only be about, I think, well, let me see here.
Well, inflation works both ways. It holds up that top number with higher prices. So margins are compressed, and I think we're seeing some demand reeling in. And
well, I mean, but if you see here,
the consumer's
right,
crunched.
Earnings growth, sales growth is only supposed to be 4%.
Mm-hmm.
That means you need 6 to 7% margin expansion.
Wow.
Something doesn't work.
It
But
doesn't.
the only saving grace for stocks is if you can get earnings growth that surprises to the upside. But I'm not smart enough yet to figure out how that's going to be.
I don't.
Because we already know margins are pretty stretched.
Yes, they are.
And they really expand more.
And then, as we discussed earlier, larger corporations are going to have these higher rates working through the system by 2024, 2025. And that higher cost of debt and capital is going to cause further margin compression.
That's what they say, right?
I believe
and
so.
We know the inflation rate has come down, right?
Yeah, so that's what held up the higher prices, the top
and sales
number.
really do follow, if you do a separate axis here, sales really do follow inflation.
Mm-hmm.
Analysts are already telling you there's going to be an uptick in inflation because they're increasing their sales growth rates.
Wow. Well, it's
yeah. I can't make it work.
It's a fantasy land. Maybe we should all go to Disney. We're hanging out in Disneyland. I don't know. You can't have your cake and eat it too.
And that's the point, right? You can't have high rates, high growth, a slowing economy,
high dollar.
In other words, the equity market can't have everything it wants, right? It can't have the equity risk premium normalized by rates coming down to it, and have 10% earnings growth next year. It can't have both. It only can have one or the other.
Yeah.
If it's that we're going to get the 10% earnings growth, but we're going to get higher rates, then the equity market needs to come down to where bonds are, right? You can't have both.
You can't have both.
So one has to give. One has to give. Either earnings estimates need to drop considerably, or the equity market needs to drop considerably. And in either case, what that probably means is that at 16 times 245, you're talking about 245 times 16 is 3920. Even let's be generous. Let's do 8. So 10% earnings growth. Let's be generous and do an 18 multiple on 245. That's 4410. That's where we are now, right?
Wow.
So it tells you there's no upside. There's all the risk is weighted to the market going down with very little risk to the upside.
It's that risk reward always, risk adjusted returns.
Right.
And so we're already at the level of that earnings
mean,
growth, which seems
if you
very
can get to
unlikely.
20, if you can get to 20, you can get to 4,900. If you get to 20 PE. I don't know if you can get a 20 PE in a 5% 10-year world.
Exactly. 5% 10-year, and higher rates. It's a different time, and rates matter. Fundamentals matter, right?
Yeah. So I mean, I don't know. I mean, it's a very hard concept, and has different investing strategies. And I have a long-term approach to what I'm doing. I'm looking to buy stocks to be able to hold them for the next 3 to 5 to 7 years. So to pay a really high premium for something today could be a disaster for me tomorrow if my if something goes wrong. And so from my standpoint, I have to be really careful with how I'm thinking about investing my money. And so from that standpoint, I've chosen to raise cash and to be passive right now and not to be involved, and to only be involved in the names I already own and not to buy anything new at this point.
Yeah, remaining liquid to seize these opportunities as they become available. And patience is rewarded. No reason to buy these levels and then watch them come down. And absolutely, well said. Doesn't mean you're short. And that's a key point here. Just because we feel this way doesn't mean we're, any of us are shorting the market.
I fundamentally don't believe in being short. I mean, it's the most dangerous thing you can do.
Cash is a position too while you're waiting. It's temporary.
And you're getting paid interest to do it now.
Absolutely.
That's a benefit of a high rate world.
Money market funds, and you can do ladders of the T-bills. You can do the 4 weeks and remain liquid.
Cash is no longer a drag on performance.
Exactly. So you can get that risk-free rate and wait until you have higher conviction and you believe that the macroeconomics along with the market makes sense and things are starting to make more sense. And it could be some time before it does. I think this will take time.
It could be. The thing that I've learned about the market over the years is things always happen faster than you expect them to. So it could take no time.
It could happen tomorrow, or it could happen in a year, or
you just don't know. I mean, clearly, look, if the S&P 500 goes down to 4,000, it's maybe a different scenario, right? If you can make a case for $245 in earnings.
Exactly. This has been so amazing, Michael. I love meeting up with you and discussing the state of the markets. And this is something I think we're going to be doing every month or two or something like that.
Whenever you want.
Yeah, it'd be great. And we love this. Thank you so much. It's been great. Thank you to all your amazing charts. We really appreciate you. And you're a dear friend. I consider you my brother, on my Twitter brother, because we get along so well, and we have a lot of fun doing this. So thank you, Michael, and thank you to all the listeners.
Thank you.